The disappointment will be broad-based on these results, particularly in a market that's so sensitive to the downside globally at the moment, and particularly within tech stocks and well-owned tech stocks. There was very little to enamour these results to investors. Unfortunately, the miss was both on revenue and on gross margins, two areas that investors were looking very closely at. And despite the fact that we saw downgrades into the results, these misses will be sharply felt by investors.
So let's talk about the gaming revenue in particular, because the game at the centre of this latest sell-off is called Monster Hunter World. Why doesn't the Chinese censor like the game? What's going on?
There has been increased sensitivity from the regulatory front, particularly given that this is the largest gaming market in the world, that the Chinese government are keen to instill socialist values on the games that they then produce in the country, and particularly given the fact that we've had these sort of moves towards these sort of tactical tournament games. That's been a global phenomenon that we've seen in terms of the popularity of those games. I think the Chinese government are very keen to ensure control of these games going forward, given the potential for them, particularly in China. So it's a trend that we've seen. We saw them banning another game in July last year for similar reasons. But having said that, on this specific game themselves, and the call Tencent, we're talking about it being a very short-term issue and them having received approvals already to reinstate that game.
So do you think the regulator's decision puts Tencent's future top line at risk? I mean, is this something that we could see continue in this space as the regulator becomes more conscious of what these businesses are developing in terms of the gaming pipeline? Is that going to be a real risk for Tencent and its investors in the future?
I mean, Tencent has a very long history of a very effective investment, both in the gaming side and beyond that. So we have to remember that this is a high-quality stock that's used to dealing with the regulators. Additionally, the Chinese regulatory environment has always been strict, so there's no real change there. What has changed is we've had top-level management changing at the regulator, which has delayed a lot of these gaming platforms. And actually the fact, as I mentioned before, that a lot of these new platform games are becoming so popular has caused the Chinese government to be slightly more cautious than they otherwise would be. On the call, Tencent, we're talking about the regulatory environment and definitely sort of getting better in due course, although they couldn't put timing on it. But I think, these concerns will eventually, I think. But obviously the market's very sensitive to downside at the moment.
Absolutely. I think saying the market's very sensitive is a nice way to put it, considering the declines that we've seen. With the heightened regulatory scrutiny, is it going to impact Tencent's ability to be able to monetize its other games like PlayerUnknown, for example?
Yeah, no, I don't think so. There are other issues as well on top of that, given that the current kind of trade war environment as well. There are certain sort of issues going on, particularly with South Korea at the moment, and the connections with PlayerUnknown with the Korean gamers is causing some kind of question marks over whether or not the government at this stage, given the political environment, will want to approve the monetizations of these games. But Tencent are adamant to the market, saying that the monetization of these games will come at some point and will be inevitable. And given the sheer size of these games, and we saw, still the downloads of all of these games within China is continuing to be very impressive. So I think eventually when these come, it's going to prove to be a further upside for Tencent, I think. And we have to bear in mind that in a very harsh regulatory environment, Tencent is still growing at 30% year-on-year growth in terms of revenue, which is similar to Facebook, and yet still are trading below Facebook valuations following Facebook's 20% fall in recent weeks. So, we have to put it in some sort of context also.
Still watching? Perfect. Click here to watch another great video from CNBC International. Oh, and don't forget to subscribe. Thanks for watching.